think one of the ways to think about this is if you were a owner of an investment property and you had a real estate agent looking after your investment property, and one day the real estate agent said to you, I've done a great deal with a neighbouring property, and you end up with 75% of that combined property, and you don't get a vote.
Welcome. Since Allan Gray does not currently hold shares in James Hardie, why has it joined other investors in complaining to the ASX that shareholders should have got a vote on the James Hardie Azek merger proposal?
I think this is an important issue for all shareholders in all Australian ASX-listed companies. At any particular moment, a company could decide to issue a lot of shares and do a takeover just like James Hardie has done. And we think these listing rules have too big a hole in them and the listing rules need to be fixed. We've been on the wrong side of a transaction like this in the past, about 10 years ago, when a company we were invested in, Rock Oil, did a reverse takeover with Horizon Oil, and at the time issued more than 100% of their shares to effect that takeover. And I think that kind of dilution is just detrimental to all holders of shares in Australian companies.
How much influence is Azek gaining over James Hardie in this deal?
So at the end of the day, I think Azek shareholders will own about 25% of the combined company. But the bigger issue here is that not just shareholders, not just the shares that are being issued, but cash that is also being delivered to Azek shareholders mean that the deal size is really quite large. And I think for deals of this sort of size, shareholders should be expected to vote. And it's a problem that they're not being given the vote this time around.
Does that mean that this is indeed close to being a reverse takeover?
I think it is. I think one of the ways to think about this is if you were a owner of an investment property and you had a real estate agent looking after your investment property, and one day the real estate agent said to you, I've done a great deal with a neighbouring property, and you end up with 75% of that combined property, and you don't get a vote. I'm not sure most holders of that investment property would be happy with not getting a vote on a deal like that. And especially so if that real estate agent has also taken on a little bit of debt to effect that transaction. We think that's a problem, and it's a problem also on the stock exchange as well.
Is it beyond doubt then that the current listing rules allow companies to dilute shareholder interests without their approval?
They absolutely do. We've seen it a few times now, Rock Oil, Horizon Oil. A very egregious example in the last couple of years was the Perpetual and Pendal transaction, where Perpetual issued 98% of its issued shares and took on some debt to effect that transaction. And it hasn't worked out well for shareholders of that company. We think these listing rules have been gamed in the past and could easily be gamed again with other companies.
Can you think of a past example when the ASX did use its discretionary powers to ensure a proposed merger or acquisition was put to Australian shareholders?
For larger companies, we can't think of one. We've seen a few examples here of reverse takeovers where the listing rules have been waived to allow the transactions to proceed. We've also seen a similar situation, not with a takeover, but with a disposal of a main undertaking, in our view, a main undertaking, when AMP divested its life insurance business. We think all of these are examples of large transactions that need shareholder approval.
The ASX rationale is that by giving shareholders a vote, listed companies are at risk of competitive disadvantage to unlisted entities in the market for mergers and acquisitions. Is there merit in the ASX's explanation?
We don't believe so. There are many jurisdictions around the world where the threshold for issuance of shares, instead of the 100% that the ASX has, is as low as 25%. We think those companies have healthy M&A markets and transaction markets. Those jurisdictions have healthy M&A markets and transaction markets. And so it's not clear to us that the ASX would be at a disadvantage in any way, or ASX companies would be at a disadvantage if those rules were changed today.
While acknowledging the concern, the ASX has now begun a review of its listing rules in relation to shareholder approvals for M&A. What changes would you like to see implemented?
Look, we're cautiously optimistic that this time around the ASX will listen to shareholders and make some of the changes that we would like to see. One of those changes is a lower threshold around the issuance of shares to effect takeovers. So instead of that 100% threshold, the 25% of listed or outstanding shares on issue would be a good threshold to have. We also think it's important that the ASX disclose any waivers that are given and maintain the transparency that we shareholders would expect to see when those waivers are granted. Those are probably the two big things that would help shareholders regain confidence in the listing rules as they currently stand.
Do you have a view on whether that company is acting in the interests of its management as opposed to shareholders? We
are not currently shareholders in James Hardie. It's hard for us to know what has prompted this transaction. We think that the transaction, though, should have been put to current James Hardie shareholders as a matter of good corporate governance.
As a stock picker and amid talk of a possible tariff-induced recession in the United States, is it good timing for an Australian company to be merging with an American home building business?
I think that's open to shareholders, and unfortunately the current shareholders of James Hardie won't get to have their say on that very issue.
Suhas Nayak, thank you for your time.
Thank you, Kirsten.